Ray Dalio manages $160 billion at Bridgewater Associates right now. Bridgewater is not just large, it is the largest hedge fund on earth. And Dalio is doing something he has never done this aggressively before. He is dumping dollars and buying gold at a genuinely shocking pace. Dalio has publicly stated 3 words that defined his entire macro outlook. Those 3 words were simple, direct, and worth billions. Cash is trash. He did not whisper that warning. He said it on global platforms. He backed those words with actual portfolio positioning worth hundreds of billions. This is not a prediction. This is a $160 billion conviction trade. And the reason behind it should concern every single investor watching right now. If Finance Insight is adding real value, subscribe to the channel now. Hit the notification bell so you never miss a critical financial update. Now back to Dalio, because his reasoning changes how you see everything. Ray Dalio built Bridgewater on one foundational principle above all others. Understand the economic machine more deeply and completely than anyone else alive. That principle drove him to predict the 2008 financial collapse accurately. He presented his team a detailed crisis forecast in 2007. Nobody believed him. The collapse happened exactly as Dalio's economic machine framework predicted it would. In 2020, he warned publicly that COVID money printing would create serious inflation. The Federal Reserve printed over $5 trillion in response to the COVID crisis. Inflation hit 9.1% in June 2022, the highest reading since 1981. Dalio was right again, and his portfolio had already positioned for it. Now Dalio is making what he personally calls his most important macro call. He describes it as a fundamental shift in the global monetary order itself. The last time the global monetary order shifted this way was in 1971. That was when President Nixon ended the dollar's direct convertibility to gold entirely. After 1971, the entire world operated on a pure fiat currency system only. Every currency became backed by nothing but trust in the issuing government. Dalio argues that trust in governments, specifically American fiscal management, is now eroding. America's national debt stands at $38 trillion as of early 2026. The Congressional Budget Office projects that debt reaching $54 trillion by the year 2034. Annual interest payments on that debt have now crossed $1 trillion for the first time. America now pays more in debt interest than it spends on national defense annually. Dalio has specifically cited this debt trajectory as mathematically unsustainable multiple times publicly. He argues there are only 3 ways a debt problem this severe resolves itself. The first resolution path is through genuine austerity, painful spending cuts and tax rises. The second resolution path is through inflation, letting prices rise to erode debt's real value. The third resolution path is through currency devaluation, making the dollar worth measurably less. Dalio believes America will choose the second and third paths simultaneously, not the first. That specific belief is the entire intellectual foundation of his gold buying strategy. Gold protects against inflation because its supply cannot be created by government decree. Gold protects against currency devaluation because it holds value across every historical currency crisis. Gold has preserved purchasing power across 5,000 years of monetary history without exception. No paper currency in history has survived indefinitely. Gold has outlasted all of them. That historical track record is not sentimental. It is the data behind Dalio's conviction. Now look at what Bridgewater's actual positioning has been doing in recent years. Bridgewater has been systematically and consistently reducing its exposure to dollar-denominated assets overall. Simultaneously, it has been increasing allocations to gold, commodities, and inflation-linked real assets. This is not a sudden reaction. It has been a deliberate multi-year repositioning strategy. Dalio described this as preparing for a big debt cycle resolution in real time. He wrote extensively about this in his research paper, The Changing World Order. The paper analyzed 500 years of reserve currency cycles across multiple major empires historically. Each cycle followed the same pattern: rise, dominance, debt accumulation, debasement, and decline. The Dutch guilder, the British pound, and now potentially the US dollar follow that arc. Dalio is not predicting American collapse. He is identifying a structural monetary transition. That transition is gradual, measurable, and already visible in multiple real-world data points now. The dollar's share of global foreign exchange reserves has fallen from 71% to 57%. That 14-point decline over 2 decades represents trillions in deliberate reserve diversification globally. Central banks are not leaving the dollar because they dislike America. It is mathematical. They read the same CBO projections, the same IMF warnings, and the same debt data. Their response has been to increase gold reserves at a historically unprecedented rate entirely. Central banks globally purchased over 1,045 tons of gold in 2024 specifically. That figure represents the 3rd consecutive year of central bank gold purchases above 1,000 tons. Nothing like that sustained central bank gold accumulation has been seen since 1967. In 1967, the global monetary system was preparing for its most fundamental restructuring in decades. The 1971 Nixon shock followed directly, ending Bretton Woods and gold convertibility permanently. Dalio sees the current central bank gold buying as carrying the same historical signal. When institutions with the most information, central banks, move this consistently in one direction, that movement always reflects something fundamental and structural, never temporary or speculative. Dalio's public statements on this have been remarkably direct and specific for a fund manager. He told CNBC that holding cash and bonds is not smart in the current environment. He specifically said gold should represent a meaningful allocation in every serious portfolio today. He warned that investors who fail to hold gold are taking a large unhedged risk. Those are not vague philosophical observations. Those are portfolio instructions from the world's best. Now consider the geopolitical dimension of Dalio's analysis, because it deepens everything. Dalio has extensively documented the rise of China as a genuine rival reserve currency challenger. China has reduced its U.S. Treasury holdings to $682 billion, lowest since 2008 entirely. That capital has been redirected into gold, yuan-denominated assets, and bilateral trade agreements. China processed RMB 387 billion, roughly $55 billion, in cross-border payments through its BRICS network. The Enbridge digital currency platform now handles real international trade settlement outside dollar infrastructure. These are not theoretical future scenarios. These systems are operational and growing right now. Dalio has described this as the most significant geopolitical monetary shift since World War II. He says the world is moving from a unipolar dollar system toward a multipolar one. In a multipolar monetary world, no single currency carries the overwhelming trust it once did. In that world, gold, the only asset no government controls, becomes uniquely and powerfully valuable. This is not abstract theory. It is the precise logic behind Bridgewater's $160 billion positioning. Every piece of data Dalio tracks points toward the same conclusion with remarkable consistency. Debt levels are unsustainable, dollar dominance is fading, geopolitical trust is fragmenting globally. Gold sits at the intersection of all three of those macro forces simultaneously right now. That intersection is why gold crossed $5,900 per ounce, and why Dalio is not selling. The investors who understood the 1971 monetary transition early became wealthy in the decade following. Dalio believes the investors who understand this transition early will experience the same outcome. The question is not whether this transition is happening. The data confirms it is happening. The question is how quickly it accelerates, and whether investors are positioned for it. The transition Dalio identified is not arriving quietly or slowly anymore. Every major data point in 2026 is accelerating the timeline he predicted. Start with the dollar itself, because the dollar story is central to everything. The Bloomberg Dollar Spot Index hit a 4-year low in early 2026. That dollar weakness is not random market noise. It has deep structural causes. America's fiscal deficit consistently exceeds $1 trillion every single year now. The Congressional Budget Office projects deficits remaining above $1 trillion annually through 2034. Persistent deficits of this magnitude are structurally corrosive to long-term currency confidence. Every dollar printed to finance a deficit is a dilution of existing dollar value. Dalio has described this dilution process as slow-moving but ultimately unstoppable without real reform. Reform requires political will, and Washington's political system currently cannot generate that will. The last genuine U.S. budget surplus was recorded in fiscal year 2001 entirely. America has borrowed money every single year for 24 consecutive years since then. Dalio's framework specifically identifies sustained deficit financing as the precursor to currency debasement always. The historical pattern is consistent. Debt accumulates, interest compounds, currency absorbs the pressure. That pattern played out in Weimar Germany, in 1970s America, and across dozens of other cases. Dalio is not predicting a Weimar-style hyperinflation. He's identifying the directional pressure precisely. The direction is toward a weaker dollar and higher gold prices over the medium term. Bridgewater's positioning reflects that directional conviction with full institutional commitment behind it. Now look at what the Supreme Court decision of February 2026 adds to this story. The Supreme Court ruled on February 20th, 2026 that IEPA tariff authority was unconstitutional. That ruling immediately created enormous uncertainty about America's entire trade policy framework. JP Morgan estimated the struck-down EPA measures represented roughly $180 billion in annualized tariff revenue. That revenue gap immediately worsened America's already critical fiscal deficit trajectory further. The Trump administration responded by invoking Section 122 to impose a 10% tariff replacement. But Section 1 and 22 tariffs carry a 150-day expiration clock. creating compounding policy uncertainty. Policy uncertainty of this magnitude is precisely the environment where gold historically performs best. Investors cannot plan around a 150-day tariff that may or may not get renewed. Corporations cannot invest confidently when the trade policy foundation keeps shifting beneath them. That uncertainty translates directly into reduced business investment and lower economic growth expectations. Lower growth plus persistent inflation is stagflation, and stagflation is gold's historically ideal environment. Rabobank explicitly described America in 2026 as facing stagflationary pressures from tariff policy. The Federal Reserve is simultaneously expected to cut rates toward 3% by year end. Rate cuts in a stagflationary environment push real yields further negative and gold further higher. Dalio identified this exact policy trap in his research years before it materialized in 2026. He described it as the inevitable consequence of running excessive debt into a geopolitical shock. America is now living inside the scenario Dalio modeled, and gold is responding accordingly. Now examine what Dalio's framework says about the international dimension of this story specifically. The IMF's April 2026 World Economic Outlook was titled Global Economy in the Shadow of War. That title alone signals the severity of what global institutions are currently assessing and documenting. The IMF's severe scenario projects oil prices 100% higher than January 2026 baseline levels. Energy price shocks of that magnitude have historically produced significant and lasting currency market dislocations. Japan, which imports over 90% of its energy, is being squeezed from both sides. The yen sits near 159 per dollar, with intervention warnings escalating from Finance Minister Katayama. France faces a $59.3 billion interest bill in 2026, up sharply from $36.0 billion in 2020. KBRA downgraded France's sovereign rating, citing persistent deficits and political paralysis preventing meaningful reform. France's debt-to-GDP ratio is heading toward 130% by 2030, according to IMF projections. Multiple major economies simultaneously facing fiscal stress is precisely the scenario Dalio's framework models. When several large economies face debt stress simultaneously, trust in all fiat currencies erodes together. Simultaneous fiat erosion creates multi-directional demand for gold as the universal non-sovereign alternative. This is not one country's problem flowing into gold. It is a global systemic signal. Dalio has specifically warned that this multi-country debt stress scenario is the most dangerous configuration. It removes the traditional safe haven rotation from one troubled currency into a stronger alternative. When the dollar, euro, and yen are all under simultaneous structural pressure, where does capital go? Dalio's answer, backed by Bridgewater's actual portfolio, is unambiguous. Capital goes into gold. Silver has confirmed this signal with extraordinary clarity throughout 2025 and into 2026. Silver delivered near 120% gains in 2025 alone, outperforming nearly every other asset class. Silver's industrial demand from solar, electric vehicles, and AI data center infrastructure keeps accelerating structurally. The combination of monetary demand and industrial demand makes silver's supply deficit increasingly severe yearly. Gold and silver rising simultaneously has historically confirmed genuine systemic monetary pressure, not speculation. Dalio's framework identifies this precious metals convergence as one of the clearest monetary stress signals. Central banks are not buying silver institutionally, but their gold buying validates the same macro thesis. Poland bought 90 tons of gold in 2024, one of Europe's most aggressive accumulation strategies. Turkey dramatically increased gold reserves throughout 2024 and into 2025 against a weakening lira backdrop. India surpassed its own historical gold reserve records during the same sustained accumulation period. These are geopolitically diverse nations acting on identical strategic logic simultaneously. That is the signal. Nations that fear future sanctions, currency weakness, or dollar system exclusion are all choosing gold. Dalio described this pattern as the most important geopolitical monetary development of the current decade. He argues it represents the foundational building of a post-dollar reserve architecture in real time. That architecture will not replace the dollar overnight. Monetary transitions take decades to fully materialize. But Dalio specifically argues that the transition's early stages are the most profitable for prepared investors. The investors who bought gold at $1,000 in 2009 following the financial crisis logic became wealthy. The investors who bought at $2,000 in early 2023 following Dalio's framework have already doubled money. The question every investor watching this needs to honestly answer is about their own positioning. How much of your portfolio is protected against the specific scenario Dalio has identified and documented? His answer for a serious portfolio is a minimum 10 to 15% allocation to gold. That allocation is not about speculation. It is about structural protection during a monetary transition. Dalio has also consistently emphasized geographic diversification as critical during this specific transition period. Concentration in any single country's assets during a monetary order transition carries enormous unhedged risk. International diversification across economies with different debt profiles reduces that systemic concentration risk meaningfully. Real assets, property, commodities, productive land, also feature prominently in Bridgewater's transition positioning. These are assets that hold intrinsic value independent of what any single government decides to do. That independence from government decision-making is precisely what makes them valuable during monetary transitions. Dalio's framework is ultimately about one thing: identifying where trust is moving in the financial system. Trust is moving away from dollar-denominated paper assets and toward hard assets with intrinsic value. Gold at $5 and $100 is not a bubble driven by speculation or retail investor enthusiasm. It is the measurable data-confirmed movement of the world's most informed capital toward genuine safety. Central banks, sovereign wealth funds, and the world's largest macro hedge fund are all aligned here. When that level of institutional consensus forms around a single asset, the signal is unmistakably clear. Dalio is not buying gold because he is pessimistic about the future of human civilization. He's buying gold because he understands monetary cycles better than almost anyone alive today. And right now, every indicator inside his framework is pointing in the same consistent direction. The monetary transition he predicted is not approaching. According to the data, it has already started. If Finance Insight is delivering real value, subscribe and hit the notification bell right now. Drop your biggest question about gold and Ray Dalio in the comments below today.